In this chapter, we are going to calculate the risk and the return and also look at some historical risk and returns. The single period return, the one period investment return is the holding period return, which is calculated as the ending price minus the beginning price plus the cash dividends divided by the beginning price. So this holding period return is for stocks because you are going to receive periodic dividend payments. If you are calculating holding period return for the bonds, the formula is very similar, but instead of cash dividends, you are going to replace it with cash coupons. So the coupon payments you received during the holding period. Now in this example, if the ending price of the stock is $24, the beginning price is $20. Within the holding period, you received $1 dividend. The holding period return will be 24 minus 20 plus 1 divided by 20, which is 25%. So most of the time for stocks, the ending price is the price you sell the stocks. The beginning price is the price you purchase the stocks. When we measure investment returns over multiple periods, we'll have to calculate the average return over the multiple periods. We have two ways to do that. The first one is called arithmetic average return, which is the average across all returns over the multiple period. You add up all the returns over these multiple periods divided by the total number of periods. The second way to calculate the average return is called geometric average return, which considers the compounding power. The arithmetic average return did not consider compounding power. To calculate the arithmetic average, you just need to calculate the sum of all the returns divided by the total number of periods. When you hold a stock for more than 1 year, in this example, 7 years, you want to calculate the average annual return. If you want to calculate the arithmetic average return, what you need to do is you add up all 7 years' return divided by the total number of years, which is 7. In this example, year 1, you have a 21.56% loss. Second year, you gained 44.63%, so on and so forth, until the 7th year, you got 17.62%. So you add them up, divided by 7 years. For this 7-year holding period, the average arithmetic return every year is 17.51%. For the same stock, the same returns over the 7 years, when you want to calculate the geometric average return, then what you have to do is you have to consider the compounding power. So basically what you need to do is you need to calculate the cumulative return over the 7-year period, then take that to the power of 1 over 7. So the first year the return is 1 minus 21.56% times the second year's return, which is 1 plus 44.63%, times the third year, 1 plus 23.35%, so on and so forth until the last year. You multiply 1 plus 17.62%. So in this way, you calculate the cumulative return over the 7 years. And then the whole thing to the power of 1 over 7 minus 1, you calculate the geometric average return. So 15.61% per year. Comparing the arithmetic average return and the geometric average return, you will always find the geometric average return is lower because it considers the compounding power. The relationship between inflation and the real rates of return is summarized in the Fisher's equation. I'm pretty sure you have studied Fisher's equation in macroeconomics before, so here is just a very quick review. So the nominal interest rate, the capital R, equals lowercase r, the real interest rate, plus the expected inflation. In this picture, we showed you the interest rates and inflation. For the interest rates, we use the T-bills nominal interest rates, which is the blue line. The black one is the inflation. The difference between the T-bills and the inflation is your real return. So if you look at a long period of time from 1926 to 2016, most of the time the nominal T-bill returns is higher than the inflation. Means if you put your money in the T-bills, you will be able to beat the inflation. But in some of the years, the T-bill returns are actually below the inflation. Means in real terms, you are actually losing money. In the following a couple of slides, I'm going to show you how to calculate expected returns and standard deviation. First of all, let's review the expected returns formula. I know you have learned this formula before in statistics, but we're going to apply that formula in finance, in stock markets. So the expected return of any stock is going to be the sum of the probability weighted average in each state. So the PS is the probability of a state. RS is the return if a state occurs. S is state. I'm going to use this example to illustrate how we use the previous slide's formula to calculate the expected return. Now we have a stock here. In 4 different states, we will have different returns. In excellent state, with a probability of 25%, the stock will return 31%. In a good state, 45% of the chance, the stock will return 14%. In the poor state, 25% chance, the stock will lose 6.7%. If the market crash with a 5% chance, the stock will lose 52% of its value. So what is the expected return of the stock? All we need to do is to calculate the probability weighted average return, which is the probability of each state times the return in that state. In this particular example, it's going to be 25% times 31% plus 45% times 14%, so on and so forth. And then you add them up, all 4 states. The expected return for this stock is 9.76%. We then will calculate the variance and standard deviation of the stock across different states. To calculate the variance, which is again the probability weighted average of the deviation of stock return in each state from the mean return. Standard deviation is just the square root of the variance. I'm going to use the previous example to show you how to do it in the next slides. Using the same numeric example, now let's calculate the variance and standard deviation of that stock. So first of all, in each state, we want to calculate the deviation of the state return from the mean return. If you recall, the mean return is 9.76%. So in the first stage, which the excellent state, with 25% chance, the stock will return 31%. So 31% minus the mean return, 9.76% squared, because here we want to measure the distance, so we want it to be a positive number, okay? Plus the second state, which is the good condition, good state, 45% of the chance. In a good state, the stock will return 14% minus the mean return, 9.76% again. Here we have the square because we are looking for the distance. So on and so forth, we calculate the remaining 2 states. So the variance is going to be 0.038. To calculate the standard deviation, we take the square root of the 0.038. We have 0.1949. Sometimes we need to measure the co-movements of two stocks. The most common measure of co-movement are covariance and correlation. The covariance of any two random variables return 1 and return 2 is defined in the following formula. In this class, the preferred measure of co-movements of any two stocks is correlation. The definition of the correlation is defined in these slides. The correlation is a number ranging from -1 to 1. If the correlation is positive, means the two stocks will move together. If the correlation is a negative number, then the two stocks tend to move in opposite directions. If the correlation is 1, means the two stocks are perfectly positively correlated. If the correlation is -1, it means the two stocks are perfectly negatively correlated. The first picture shows the stocks with high correlation when the correlation rho is very close to +1. The two stocks move together very closely as shown in the picture. In the second picture, there is little correlation between the two stocks. The correlation rho is very close to 0, means the movement of the stocks are independent of each other. The last picture shows negative correlation stocks. When the two stocks have negative correlation very close to -1, they move almost opposite to each other. If one stock goes up, the other stock goes down. The correlations and covariance do not depend on mean returns. The mean returns are just constant numbers as shown in the pictures. The correlations and covariance are independent of the mean returns. When we build stock return models, most of the time we will assume the stock returns follow normal distribution. Normal distribution looks like a bell-shaped curve, just like the blue curve in this picture. In this picture, we assume the stock return with a mean return 10%, which is the number right in the middle, and the standard deviation of 20%. What we can tell from this normal distribution, if the stock return follows this normal distribution, which means within 20% or within one standard deviation, means the mean is 10%. Okay, within one standard deviation, which is 20%, on the right hand side, 20% higher than the mean return 10%. So 10% plus 20%, 30%, which is the positive one standard deviation point, 30%. On the left hand side of the mean, negative one standard deviation means 20% lower than the mean return of 10%. So 10% minus 20%, which is minus 10%, which stands at minus one standard deviation. So what does that mean? It means for 68.26%, we are confident that the stock returns will fall between negative 10% to positive 30% if the stock returns follow this normal distribution. When we use standard deviation as the measure of the stock return risk, we are actually looking at both sides, the extreme positive return and extreme negative return. We're looking at the tails of the normal distribution on both sides, left and right. But in reality, we are only concerned with the left-hand risk, which is the extreme negative return or the extreme loss. We don't really worry about the right-hand side, because if we have an extreme positive return, that is just perfect, right? So sometimes standard deviation is not a very adequate measure of risk, because people are more concerned with the left-hand side loss risk. Most people are very concerned with the left tail of the normal distribution, which is the extreme negative event. How to measure this extreme negative event? Most people will use value at risk. Value at risk assumes the return distribution follows a normal distribution, and commonly we use 5 percentile of the return distribution. It means with 5% probability, the return will be equal or lower than the VAR, which means 95% of the returns will exceed the VAR. We're going to use the following example to show you how to calculate and interpret VAR. The expected return of US large stock portfolio is 12%. Standard deviation is 20%. What is the VAR? Using the 5th percentile of the return distribution. If you check the one-tail test of the normal distribution on any statistics books, you will find the cutoff value is 1.65. So we are going to use that number in the formula. So the VAR is the expected returns minus the cutoff value times the standard deviation. In this example, 12% mean return minus 1.65 cutoff value times 20% standard deviation, negative 21%. It means if you had invested $1 million in a portfolio, the largest loss measured by the VAR is $1 million times 21% loss, $210,000 loss. Basically, the model shows you 95% of the chance your largest loss is going to be smaller than $210,000. Only in the most extreme negative case, which is the 5% on the left tail, you will lose more than $210,000. Value at risk is a very handy tool for people to estimate the left-hand side risk, the extreme negative risk. But one problem with the value at risk is it assumes the normal distribution. But in the real life, the real stock returns are never normal distribution. The real returns looks more skinny and taller, like I showed in the picture. Comparing to the normal distribution, the real stock return distribution is a lot taller, skinnier, which means the tails are a lot fatter than the normal distribution. Since the real stock distribution has a bigger, fatter tail than the normal distribution, as I circled in the blue circle, which means value at risk almost always underestimate the extreme loss. So how much value at risk underestimate? Assuming the normal distribution and the 5th percentile and 1.65 cutoff value, let's calculate the large and small stock value at risk. The large stock value at risk is minus 23%. Small stocks value at risk is 44% loss, which means 95% of the chance for the large stock portfolios you will not lose more than 23%. For the small stocks, 95% of the chance you will not lose more than 44%. So basically, the value at risk shows in the 5% extremely negative event, the large stock portfolio may lose more than 23%. The small stock portfolio may lose more than 44%. But when we look at the real historical return numbers, in the 5% most negative returns, large stock portfolio could lose more than 30%, while the small stock portfolio could lose more than 62%. So the value at risk always underestimate. If you use the T-bill returns as the risk-free rate, which is RF, then the risk premium or the excess return of a portfolio is the expected return of the portfolio minus the T-bills return. it is a very important concept. For example, if I tell you a portfolio gives you 10% of the return, you don't really know whether the return is good or not. If I tell you the T-bill return or the risk-free rate return is 2%, then you calculate the risk premium, which is 10 minus 2%, 8%. You know, comparing to the risk-free return, you are getting 8% extra for holding a riskier portfolio than the risk-free asset. So this is a reasonably good portfolio. If I tell you the T-bill rate is 12%, then you calculate the risk premium, which is 10 minus 12%, a negative number, which says by holding a riskier portfolio, you are actually losing 2%. So that is not a very good investment at all. You are better off to hold risk-free T-bill returns of 12%. So that is why we always calculate the risk premium of any risky portfolio. We use risk aversion to measure the degree to which investors are willing to commit risk. The greater the level of risk aversion means the person is very conservative. That person hates risk and would like to hold a larger portion of the risk-free asset. Lower level of risk aversion means the person is more aggressive, is happy to hold a larger portion of the risky assets. To quantify the degree of risk, we use a parameter capital letter A. A scales from 1 to 10. Investors with risk aversion level 1 is the most aggressive type. They have a big stomach for risk. They can take the highest level of risk. So how do we assign a number to each investor's risk aversion level A? Most of the time we do a survey, ask questions on investors' income level, their willingness to take risks. The formula in the blue box shows the relationship between the risk premium and the risk aversion. So let's look at the right-hand side first. Sigma p squared is the risky portfolio's variance, the risk. So the higher the sigma p squared, the higher the risk of the portfolio. The higher the risk, the higher the risk premium the risky portfolio has to offer to compensate for the higher risk. So there is a positive relationship between the risk and the risk premium, or the excess return over the risk-free rate. Then we look at the capital letter A, which is the risk aversion level. So the higher the level A, the more conservative an investor, which means for more conservative investors, the risky portfolio has to offer a higher risk premium for that person to invest. We also see a parameter 1/2 in the formula, so that is just a constant number. Later on, we will need to calculate the first order condition of the sigma square. So when you take the derivatives of the sigma p square, that becomes 2 sigma p. So 2 and 1/2 will cancel each other. So the reason we put 1/2 in the formula is just for simplicity in the calculation later. The T-bill return is 5%, risk aversion level 4, risky portfolio standard deviation is 22%. The expected return of the risky portfolio is at least what percentage for this particular investor to invest. We plug in all the numbers in our formula, so the expected return of the portfolio should be 5% risk-free rates plus 1/2 times risk aversion level 4 times sigma p squared, which is 22% squared. The final number is 14.68%. It means the risky portfolio should offer at least 14.68% for this investor to invest. In investments, we love returns, but we hate risk. How do we measure the trade-off between the return and risk? The Sharpe ratio, or the reward to volatility measure, is a very important measure to measure the portfolio performance. It is defined as the portfolio risk over the standard deviation of portfolio excess return. For example, if the portfolio return is 10%, T-bill return is 3%, the portfolio risk or the standard deviation is 20%, then we can calculate the Sharpe ratio, which is risk premium 10 minus 3% divided by the portfolio risk 20%, 0.35. So the higher the Sharpe ratio, the better the performance. So when you are comparing the performance of any two stocks or portfolios, you always want to pick the highest Sharpe ratio one. So what do we know about returns and the risk? In the following picture, we are going to look at some historical numbers. In this, we look at some historical returns over the long period of time from 1926 to 2016, 90 years. Now suppose we have $1 to invest at the beginning across different assets. Let's take a look at what are the returns and the terminal values at the end of the period. We first look at inflation as a benchmark. On average, over this 90 years period, inflation is 2.9% each year, which means $1 in 1926 is equivalent to $13 in 2016. So the purchasing power of $1 in 1926 is equivalent to $13 in 2016. Okay, so if you put $1 in the treasury bills, which offers 3.4%, which is better than inflation, at the end of the period, the treasury bill will deliver $21. You can do slightly better when you invest in the government bonds, which offers 5.6% every year in this period. So your $1 will turn to $132. The stock markets have a lot better performance. If you put $1 in the large stocks, say S&P 500, the average return is 10% annually, and you end up with more than $5,000. Small stocks offers on average 12% return over this long period of time, which means $1 at the beginning will turn to more than $26,000 if you invested in the small stock market. We will now introduce the most important idea in this chapter, the asset allocation. Asset allocation is the portfolio choice among broad investment classes. For example, if your portfolio has a bond and a stock, asset allocation means the choice of the percentage of stock and bonds. If you put 40% of your money in stock, which means 60% of the money goes to the bond. So that is one example of asset allocation. Complete portfolio means the entire portfolio. Whenever we mention complete portfolio, it must include one risk-free asset and some risky asset. So it must include a risk-free asset to be called complete portfolio. The risk-free asset is the T-bill. We are going to use the T-bill as the proxy of the risk-free asset. Risky asset could be stock, could be bonds, could be a portfolio of stocks and bonds. Capital allocation is the choice between risky and risk-free assets. We're going to use the formulas at the bottom of this slide to calculate expected return and standard deviation of the complete portfolio. In the formula, lowercase y is the proportion of money you put in the risky portfolio. Therefore, 1 minus y is the proportion of investment you put in the risk-free asset. Because in the complete portfolio, we only consist of two portfolios. One is risk-free asset, The other one is risky portfolio. RF is the rate of return on risk-free asset. Expected RP is the expected return of the risky portfolio. Sigma P is the standard deviation of risky portfolio. Expected RC is the expected return on complete portfolio. Sigma C is the standard deviation of complete portfolio. So if you look at complete portfolio's expected return, that is proportional to the returns of risky asset and risk-free asset. Y is the proportion you put in the risky portfolio times the return from the risky portfolio plus 1 minus Y, which is the proportion you put in the risk-free asset, times RF, which is the risk-free asset return. Sigma C, or the standard deviation of the complete portfolio, is proportional to the risky portfolio. Specifically, we have Y, which is the portion you put in the risky portfolio, times sigma P, which is the risky portfolio's risk. Why we don't have sigma F, which is the risk of the risk-free asset in this formula? Because sigma F is 0, because risk-free asset or T-bills in our example, in our theories, has 0 volatility, means 0 risk. So sigma F, or standard deviation of the T-bills, is always 0. So that is why the complete portfolio sigma is just proportional to the risky portfolio, because risk-free asset has 0 risk. In this numeric example, I'm going to show you how to calculate the complete portfolio return and risk. Now assume the risk-free asset or the T-bill return is 7%, risky portfolio 15% return. The proportion of the money you put in the risky portfolio is 75%, means 25% of the money is put in the risk-free asset. Sigma P, or the standard deviation of the risky portfolio, is 22%. To calculate the complete portfolio return, that will be 75% of the money you put in the risky portfolio times the risky portfolio return, 15%, plus 25% of the money you put in the risk-free asset times the 7% return from the risk-free asset. The expected return of the complete portfolio is 13%. To calculate the risk, or the standard deviation of the complete portfolio, which is just proportional to the risky portfolio standard deviation, 75% in the risky asset times 22% standard deviation of the risky portfolio, you got 16.5%. In this chapter, now we will draw the investment opportunity in the risk and return space. In the risk and return space, we always put the expected return on the vertical line, and on the horizontal line we have the risk, which is the standard deviation. We start from the risk-free asset, which is portfolio F in the picture. Portfolio F has 0 risk, so 0 sigma, 7% return on the vertical line. So we identify the first points on the space, which is portfolio F. The second point in this space is the portfolio P, the risky portfolio. The risky portfolio has 15% return on the vertical line and 22% risk on the horizontal line. Now we have 2 points, F and P. Connecting the 2 points, we have the pink line, which is called capital allocation line. Capital allocation line is a very important budget line for all investors. All combination of risky and risk-free asset will be on the capital allocation line. For example, if we pick the point where Y equals 50%, means you equally put your money in the risk-free asset and the risky asset. the complete portfolio's return will be 50% of your money in the risky portfolio, 15% return, plus 50% of the money times 7% return from the risk-free asset. The complete portfolio return will be 11%. Complete portfolio standard deviation will be 50% of the risky portfolio, so 50% times 22% standard deviation. That is 11% standard deviation. So that is one choice of complete portfolio, which lies on the point where y equals 50%. If we increase the percentage put in the risky portfolio, say in the extreme case, we put 125% of our money in the risky portfolio, so y will be 1.25. Then how much money you put in the risk-free asset? That is 1 minus 1.25, negative 0.25. What does that mean? When the ratio is a negative, it means instead of investing your money in that asset, you are borrowing against that asset. In this particular case, you borrow 25% of the portfolio from the risk-free asset. Use the borrowed money. You put 125% of the money in the risky portfolio. So the complete portfolio's return will be 125% times 15% from the risky portfolio minus 25% times 7% T-bills. So the minus sign here is like you borrow against the treasury bills. You borrowed money from risk-free asset and use the borrowed money to invest in the risky asset. When you borrow from the T-bills, you have to pay the interest. So the 7% is like your borrowing rate. You have to return or pay the return to the T-bills. So the complete portfolio's return is 17%. Complete portfolio's risk will be a lot higher because that is proportional to the risky asset. So 125% times 22% risky portfolio's risk. So the complete portfolio's risk is 27.5%. So you can see when you borrow money to invest, your return is higher, but at the same time, your risk is also going to be higher. The capital allocation line also shows the Sharpe ratio in the picture. Can you see where is the Sharpe ratio? Yes, the slope. The slope of the capital allocation line is exactly our Sharpe ratio. Remember the definition of the Sharpe ratio, which is the risk premium over the standard deviation of the risky portfolio. So what is the risk premium of the risky portfolio? Which is exactly 15% return from the risky portfolio minus 7% risk-free assets. The distance from the risky portfolio and risk-free asset, which is 8%, divided by the sigma p, 22%. So 8 over 22. The slope of the capital allocation line is exactly our Sharpe ratio as shown in the picture. Capital allocation line is like a budget line for all the investors. Each individual investor will pick a combination of risky and risk-free asset on the capital allocation line. So what is the optimal combination of risky and risk-free asset for each individual investor? Or what is the optimal Y? Y star in this formula is the optimal Y for each individual investor. The numerator will have the risk premium of the risky portfolio. On the denominator, we have the risk aversion level A and risky portfolio's variance. So in this formula, A, or the risk aversion level, is a unique number to each individual investor. So that is why the Y star, or the optimal ratio you put in the risky asset, is also a unique number to each individual investor. In this chapter, for example, if we have individual investor with risk aversion level 4, let's see what is the optimal proportion of money he wants to put in the risky asset. According to our previous formula, Y equals risk premium of the risky portfolio, 15 minus 7%, divided by A times sigma square of the risky portfolio, which is 4 times 22% squared. So the optimal ratio is 41%, means for this particular investor with risk aversion level of 4, he wants to put 41% of the money in the risky asset, which means the remaining 59% goes to the risk-free asset. So for this particular investor, the complete portfolio's expected return will be 41% times 15% risky portfolio return plus 59% money you put in the risk-free asset times 7% return from the risk-free asset. The weighted average return is 10%. That is the complete portfolio's return for this particular investor. The complete portfolio's risk or the standard deviation is proportional to the risky portfolio, which is 41% of the money you put in the risky portfolio times 22% standard deviation of the risky portfolio, 9%.